Imagine this, Adani needs 1000 crores rupees to build a new port. Instead of taking just a bank loan, they raise money by issuing bonds. A bond is simply a loan from investors like you to a company or even the government that needs funds for their projects. Here, Adani becomes the bond issuer, the one borrowing money. You, the investor, are the lender. Why is the issuer important? Because your returns and safety depend on who is borrowing. The safety of your money depends on their ability to repay. For example, when a company like Adani issues bonds, investors look at its financial strength to judge risk. Now, who can be an issuer? Government to fund roads, railways, welfare. Banks, NBFCs to expand lending. Corporates to fund new projects, refinance debt, and expansion. So, before you invest, don't just check the interest rate. Always ask, who's the issuer and can they pay me back? If you found this useful, subscribe for more fixed return investing tips.
Investments in debt securities, municipal debt securities, securitized debt instruments, mutual funds are subject to risks, including delay and/or default in payment. Read all the offer-related documents carefully.